Five, four, three, two, one.
Hello and welcome to Money Matters. I'm Sarah Peterson here with Dean Greenberg, CEO of Greenberg Financial Group. Good morning. I won't just run in.
There you go. Good morning again to you too.
I know I have a tendency to just hit you right out of the gate.
Sometimes this is on after the news at night too. So
yeah,
it's on 9:30 on Sundays and 10:30 on Sunday nights after the news.
Well, then hello. Yeah. Hello.
Hello. Hello, Sarah.
Always great to see you, whatever time of day it is. We always have so much to talk about. We have always a plan, like we're talking about planning of what to talk about, and then we get derailed. But I think everything we're talking about is always, it's always pertinent and important to the viewers because these are questions we've received. These are issues and topics that need to be discussed because these are things that we don't learn in school and people don't always have the answers and don't know where to go to find out how do I plan properly to get where I need to be to retire the way I want to. I mean, we've worked our entire lives for that moment where we can say, I get to choose what I want to do, but you need to plan to get there so you can do it properly.
Well, there's a couple things too. People have more money than they used to, okay? It might not go as far as it used to, but people have a lot more money. That's why, we don't have 25-cent hot dogs anymore. Okay?
And they're not doing pennies anymore.
Right, exactly.
No more pennies.
So the number is much bigger, but you still, and so it gets scary about the planning because everything costs more money. Where it might have cost a couple $100, $500 to get things fixed around your house, now it's $1,000, $2,000, $5,000 to get things fixed. Everything costs more, so the planning is so important that you're in that position. And remember, at first, you're in the accumulative phase while you're working, putting money away, and everyone says, I'll get to it. And that's why they need to come in early and start planning. Because if you're putting money away when you're 20s, 30s, and 40s, and is a lot better than waiting till you're in your 50s and say, now I can put money away. Yes, we have the catch-up plan, but an extra $5,000, $7,000 a year is good, but it ain't going to put you where you want to be.
Well, the thing you can't buy yourself is time. You cannot buy it back. So to start, maybe obviously things are looking differently in your 20s, 30s, 40s, and we have all these phases. But it's always good to know what the end game is.
You get to late 40s, 50s, you better start planning. Everyone says for your retirement, I'm planning for your lifestyle. Because a lot of people still work, okay? But you want a lifestyle over and above that. Because you might want to, I'm going to work and bring in some income because I want to work, I want to do stuff, but I want to travel. Mm-hmm. So what is that over and above is that traveling going to cost me other than my income?
A lot.
Right. So plan for a lifestyle. Now, a lot of people go, I don't know what my lifestyle is. Yes, you do. Because you have dreams. Lifestyle is fulfilling dreams that you have. And that's why I wrote my book. That's what I did for telling people about it. You can show that if you want.
Book,
there you go.
I'm so proud.
Called The End Game.
Yeah.
Obviously, if you look at that, that involves a lot of my life. I've been coaching football for over 20 some odd years. It's about planning. When I'm planning for a football game, I put a plan together. I study all week to put an offensive plan or a defensive plan together. Then when I'm in the game, guess what happens? Things might change or they might just be going great. But at halftime, you change. Every time you do something, you change to make it beneficial. Because every time you do something, it's a learning experience. So you start off thinking, these are my dreams of my lifestyle that I want. And then you try to achieve that.
Well, but that's a good analogy in terms of the financial plan, because this isn't like a set it and forget it kind of thing. Your life changes, and so therefore your plan has to evolve with it, right? We have jobs that change. We have births and deaths and marriages and divorces and all these things. Inevitably, we will have change. So important to revisit that plan.
100%, and things do change. Your own feelings change. When you're 40 years old, you're thinking about one thing. When you're 60 years old, you're feeling a whole different way. Health has everything to do with it. If you talk to any one person, when they say, you know, when you talk to them as they're older, they're just happy they're healthy. And if they're not healthy, they just, they want to get through life. They want to figure out what they got. Everyone has different things. That's what it comes down to. That's why we plan. A plan, believe it or not, whether you think you have a financial plan or not, you do, because you're thinking about it. You're thinking about your retirement. You're thinking about what you're going to do, but you might not be setting up your retirement correctly. Your 401k plan might not be invested the way it should be. Your outside investments not be invested the way they should be. Okay? Maybe you're just sitting in the bank and not even keeping up with inflation. You know? There's so many things that you have to do to get ahead that you don't know about.
And you can plan properly, and then you're thrown a curveball, and you have to find a ways to change that plan to meet those expectations. It's so interesting.
I like how you stay with the sports analogy. A
Well, I love
curveball
that.
is one of the hardest things to hit.
This is so cool.
Yeah.
Well, you know what? To be honest, you know, I played sports as a kid. Soccer was big in New York, as you know. Every kid played soccer. But I do see the benefit with my kids. What?
I didn't. Well, I should say that.
Long
I was
Island
always
was big
against
into
soccer.
soccer.
I was always against soccer. And then a friend of mine, about a year ago, sent me this picture of us in 6th grade when we won the city championship for soccer.
Yeah. I met my best friend. We're still friends when I was 7 years old on the Redheads soccer team. So you can meet lifetime friends. But in speaking of that, when I look at my kids, the team sports really give you a perspective. It's greater than yourself, right? You have an onus to other people. And I love your team perspective, because if I were coming to you and I was, you know, feeling a little nervous about sharing my financial, like, you know, plan or what I have in store, that you have a team of people. It's not just you. It's, you know, Dylan now is president, and Todd, and this whole team perspective where, hey, Dean's not here. Somebody is always there to help guide and be there for them.
But you have a point person.
Yeah.
Okay? You know who it is. And it's a small team. We're Tucson. We don't want to be this big conglomerate. I will never, as long as I'm in charge of going on at the Greenberg Financial Group, have a computer answer the phone. Press 1 for this, press 2 for this, press 3 to hang up. You know what I mean? I just won't do it. I want a person answering the phone. Now, if we're all busy, it will go to the old-time answering machine. Please leave your message. We'll get right back to you. Boom. We get right back to you. Even on weekends, I got somebody that always checks in and see if there's any messages that are important, and we'll get back to people.
Well, speaking of that, I'm going to take a quick commercial break. When you call, that's the number, 520-544-4909. Ultimately, you are going to get somebody on the phone who can answer your questions. They are going to help you get in, make an appointment. There's coffee there, which is very exciting also. And to create that financial plan to tell you whether you're on the road to retirement the way you want it.
This is what they had to get a cappuccino machine now.
I mean, of course they do.
I said, whatever. I don't drink coffee. I don't drink cappuccino.
I love
You want
some
that?
good
You can have
foamy
one.
milk, okay? And so do a lot of people. But this is something that we offer to you guys for sitting here, listening to us, educating yourself. A financial plan can cost you upwards of thousands of dollars. This is literally complimentary for you, for the listeners, to come in and find out whether you're on the right road to retirement. When we get back, we're going to talk so much more about your money matters. So please stay with us.
As a good saver, you've been putting away money during your working years. Studies find that the biggest fear of retirees is running out of money. Market volatility isn't just the downward movement of stock prices, it's the size and frequency of change. The more dramatic the ups and downs, the higher the volatility. This can put savers who are newly retired or a few years away from being retired at greater risk. Today's generation of retirees is not receiving traditional pensions as our parents or grandparents did. Instead, we have retirement accounts such as 401ks or 403bs. These accounts typically expose your money to market risk. The last thing you want right before retirement is to lose a portion of the money you need for income. But how do you turn these accounts into a retirement income? Is it safe to keep all your retirement money sitting in the stock market? The last thing you want is to lose a portion of the money you need for income due to market loss. By working with a financial professional, you can learn how to turn a portion of your savings into an income stream for life and income for the life of your spouse if you're married. We all have moments in our lives when we wish we had taken action sooner. Don't let procrastination reign on your retirement parade. Act now before it's too late. Please call our office to set up your no-cost, no-obligation retirement income review today.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg, CEO of Greenberg Financial Group. Let's be honest, during the break we're talking about how mortgage rates have changed, but it's interesting because if you look at a historical perspective, they used to be in the 80s so high. People complain now they were 2 and 3% years back, and that was wonderful.
What was your first mortgage at?
My first mortgage, oh my gosh. Well, I think maybe it was 6 or 7%. But then our next mortgage after that was 2.75.
So that means you're young, because when I got my first house in the mid-'80s, it was 13.5%. And that was an adjustable.
Right.
Okay, if you wanted a fix, it was like 15%. 15%. But we all survived.
Yep.
Because things were cheaper, I guess. Now, the average is between 6 and 7% where interest rates have been. And for mortgages, and people were complaining until recently because now they're getting used to them. When you were 2.5% to 3.5%, and they jumped to 4.5%, 5.5%, 6.5%, 7.5%. That was high, but now they come back into the 6s, high 5s. People are more comfortable now.
Well,
now, the interesting part that people don't realize is the Federal Reserve has been lowered rates 3 times in a row. Rates on mortgages don't necessarily come down every time they do that, because they really go off the 10-year Treasury. And the 10-year Treasury has just been hovering somewhere between 4% and 4.2%, no matter how much they've been bringing the rates down. So until the 10-year Treasury, which is what trades in the open market, comes down, the interest rates for you and me don't come down that much.
Well, I mean, it wasn't that long ago, a few years back, where rates were around 2.75, or you could get, 3%. It would made it a lot easier to decide, okay, well, I can make more than that in simple investing, 4% and up. So it made sense, those mortgages. But how do we decide now? I mean, if you're looking at 6.5%, 7%, if the money is best off, there or parked somewhere else?
Well, the bottom line is, all right, that all comes down to the answer when people retire. Should they pay off their mortgage or not? All right? And the idea is it has to be, again, what kind of lifestyle you want. What kind of mentality do you have? A lot of people want it debt-free because they think there could be horrible things, and if horrible things happen, then they want to know that they can live in their house and no problem. I don't have a problem with that. I understand that. But if you have a 2.5% or 3% mortgage, it does not make sense, because you can put your money in government treasuries, make the same amount of money, get the tax write-off, let it reduce, and still have your liquidity and your principal. But if you're 6.5%, 7%, anything over 6%, 7%, I absolutely say you want to pay off your mortgage, go ahead, because at that point you're making 6 or 7%. Which sometimes in the markets are low, sometimes in the markets it's great. You don't know, but you're getting 6 or 7 by paying it off. So depending on the person, depending on the stuff. But now if you're going to pay off your whole house and you have no liquidity, that's a little tough decision there. So everyone is different, and it all depends on your health. It depends on what you want to do, depends on your lifestyle, but that's why you do a plan.
Well, I mean, do you worry about housing in terms of, this next generation? I mean, I look at my kids and I wonder, will they be able to afford? I read a statistic recently where it's like kids, the average age of their millennials that are buying homes is like 35 and up. Like, they're not buying homes till much later. They can't afford it. Wes, back in the day, you got out of school and you started a family and you get a home and
you're asking me, is there a big separation between people, the haves and the have-nots? And that worries me. I think there's more of a separation. Now, I try to analyze that a lot. Is that because of the way we're going, the economy, or is that also part of our social-minded people now? Okay? When we have social democrats winning in big-time cities, for the people voting for them want free stuff, the housing market ain't going to work for them. Okay, because they want public housing. They want affordable housing that's cheap. They don't want it. They want subsidies. That mentality scares me more than can people afford homes. I look at my own kids. They're buying homes that were so much smaller than my first home and double of what I paid for my first home. But then I look at what I paid for my parents. I paid 10 times more than what they paid for their house when I got my first home. As long as we keep making income, we keep growing the economy, it's fine. The difference is mentality. People now that want to work hard, show up to do the things, want to become educated, believe in success is a good thing, will be able to afford the homes. Mm-hmm. It'll feel like everybody else. When you got your first home, it didn't matter what you were paying for it. It was unaffordable to you because it was the biggest thing you ever bought, right?
Yeah.
So, yes, you can go buy $1 million home right now if you want to have a lifestyle and also be able to do it because interest rates are high. But if interest rates went back down to 3%, that house that you bought for $400,000 or $500,000, now you can afford $1 million house because it's going to be the same.
There
the
just
same deal.
there isn't a lot of starter homes now under $500,000 anymore. It's
That's
just
right.
crazy.
Because we're not building. We haven't been building a lot of new homes. So people are buying the homes who can do it. And the people buying them are the ones that have the mentality of not a social democrat, that just want things free to them. And then believe everything should be given to them. And then we should live in a society that people that do well should be giving everything to the people that don't want to work.
That sounds like not our economy. It does not sound like capitalism.
No, it's not capitalism. And that fears me more than anything else because these are big cities. New York is a big city, okay? You and I grew up there. We understand it. We always were a democratic city until you left. Okay? But it wasn't what it is now. We still worked hard. We still believed you earned what you got. We always believed you helped those that didn't. But now there's people that are able-bodied that just want a free ride. And that's the problem. That worries me more than can people afford the homes.
Well, in any case, there's a lot of things that we cannot control. And so the important thing is creating a plan that is changeable, that is malleable, and we're just going with the times because the times, they are changing and fast.
Right.
And something that we need to be cognizant of. We are going to take a quick commercial break, but I do want to say that phone number on the bottom of the screen, that's where you're going to call so that you can get to somebody at Greenberg Financial and get that financial plan done for you. Absolutely free of charge for sitting here and listening to us educate you, hopefully, and just gab. But we do really believe that your money matters, and I hope that you do too. So give that number a call, 520-544-4909. We'll take a quick commercial break, and we'll talk more about your money matters.
This is Money Matters with Dean Greenberg of the Greenberg Financial Group. I'm Spike Spangle. Dean, what really got you started in this industry?
It was because I was working for Ford Motor Company. I had ordered all the dealerships and I kind of looked at things and I said, this is not what I want. So I went back and got my MBA in finance and investments and said, I'm going to work on Wall Street. I didn't really know the journey I was going to have until later on, 1987, when the market crashed.
Yeah. Black Monday.
Black Monday. The only person in the company of 600 and some odd brokers. I was buying IBM and I opened a $500,000 account. So they say to me, hey, this is unbelievable. How did you do this? What did you do? I just said, because I thought it was the right thing to do. Down 20%, it was probably a good time to buy, and I was more of a technician and an advisor and an educator at that time. Long story short, they tell me a week later, I never owned the stock. The back offices back then could not handle 1 billion shares a day. So a week and a half later, they tell me I don't own it, and I needed to call a client to tell them they didn't own the stock. And I told them that they should pay the client. Next day I came in, my box of stuff was in there, and they told me I was fired. And I went to go see the guy I knew to go get a job. And he said, Dean, I'd hire you tomorrow, but you need to start your own business. I laughed at him and said, how am I gonna start my own business? I only have $5,000. He said, figure it out. We're all salesmen. You educate, you care about the markets, you care about your clients. So I guess I figured it out.
Hello and welcome back to Money Matters. I'm Sarah Peterson here with Dean Greenberg, CEO of Greenberg Financial Group. We're talking about the volatility of the markets. Rates are dropping. People are unsure of which way to go. And you have some perspective on it.
One of the things we do in our financial planning and our office, family office, one of the things we do, and we've been doing this for a long time, I've been doing it over 40 years, is actually manage the money of our plan. That sets us aside. And when we manage money, we just don't buy and hold and say everything's going to be fine. What we do is we manage money, risk reward. We understand risk reward. And then we compare the risk reward of the markets versus the risk reward of what you're willing to take. So we know how to hedge, we know how to do stuff, and we're aware of the markets. But I'm going to tell you right now, if you want to keep up and you want wealth, you're going to have to be, part of your monies have to be in the markets, at least in the indexes. And here's why I like indexes. It's the only thing you know that will always go up over time. People go, oh, how do you know that? They fall. I said, well, first of all, you can look at the charts. But what you don't know is a small little secret that happens. They go, what is that? I go, when you're not able to keep up with the Joneses in the Dow Jones or the S&P, they take you out and they put in the new company that is doing well. They go, what do you mean? I said, go back and look at the Dow Jones 30 stocks from 20 years ago, 30 years ago, 50 years ago, and look at where they are now. AT&T is not even in it, okay? You got Verizon now, but if you think about it, Apple is in it. Amazon, you've got NVIDIA, okay? You got tech companies that are now in the Dow Jones when before they used to be industrial. That's because that's where we are now. We're in the AI industrial revolution before we were in the smokestack revolution. They always take out the ones that are underperforming and put in the ones that are performing. That is why you buy the indexes. They are made to continually go up over time. They are always made to go make new highs. So you buy the S&P 500. Now why do you buy the S&P 500 or the Dow Jones? Simple. President Trump has gone ahead and talked about and discussed and wants it put into law that we set up kids' accounts that every kid that is born will get $1,000 from the government. But not only that, you will be able to, and other people will be able to, is to put up to $5,000 more a year into that account for the child. That will create wealth, all right? It's sort of like I always keep saying, if Social Security was our own accounts,
and this is tax deferred, or how is this working? What happens with that $5,000?
It has to go into the S&P 500.
Okay.
I don't know, because they haven't come out with the details on how it's going to be.
Okay.
If it's going to be taxable down the road, I got to believe it's going to be tax-free because it's coming out of money that people are paying.
Yeah.
The government's paying. They're not getting a tax break. You know what I'm saying?
Yeah.
If you're putting in $5,000, I don't know if that's a tax write-off to us or not. If it is, I'd rather see it like a Roth. You don't pay taxes on it when it grows. Mm-hmm. If everyone is able to do that and put that in each year, that money will amass to a lot of money, okay, over a period of time. And of course, it needs restrictions. But the fact that everyone's always going to be putting money, I'm going to say billions of dollars a month, eventually, into these S&P 500, that is going to give it a floor. That is going to give it the opportunity to keep going higher. So anytime you kind of see it fall down, 10%, 50%, you always want to add more. But if your dollar cost average into it over time, in those accounts, they're going to do great. And if you're looking for opportunities with your other money, you do it because it's going to have a floor. There's always money going into it, and they're always going to take out the worst performing stocks and put in the best performing stocks.
So talk to me about how you're advising your clients. You have such a unique way of advising, but you manage the money in-house. So this is the market's just like one component of how their retirement planning is going. There's so many little buckets that they have.
Right. Well, that's where the plan is, okay?
Yeah.
The money is, it's the funniest thing because you put this whole plan together and you talk about Social Security, you talk about paying for health care, all the things that you need, Medicare, all the stuff that's there, and then what's left over is investments, and then everybody plugs in this little number, boom, here's your plan, does it work? Well, if you don't make that little number plan, whether it's 7%, 8%, 10%, 3%, whatever it is, and you should always use 7%, in my opinion, unless they're mostly bonds and you go down, if it's mostly stocks, maybe go to 8%, because there are down years, there are up years. You can always show a plan better showing 10 to 12%. You don't do that. The whole idea is being able to make the portfolio grow over time. Over time, with not taking so much risk, because what you don't want people to do is when the markets go down, panic out. You can't. What we do, though, is we do implement hedging strategies, insurance strategies on accounts when we feel that the market is vulnerable. At this time right now, I'm uncomfortably bullish, meaning I believe the markets can still go higher. I believe that we can keep going if we allow the things to happen that the Trump administration wants to put in. I'm not talking about anything but the economy, okay? The economy, okay?
Thank you for clarifying
If
that.
they can do those things that we need them to do, I believe it works. But if every time we're turning around and he's getting sued for something from the courts that you can't do this or you can't do that, we're not going to get implemented. I love the idea about these plans. Putting money in for kids, putting money in, making Americans wealthier. That's what we're trying to do. That brings the lower playing field up to the upper playing field, as opposed to everyone else wanting to take the upper playing field and bringing them down to the lower playing field. That won't work. We are capitalism right now. Hopefully we're that way in 10 years from now. But right now, most cities, most people believe in capitalism. There's this underpinning that's coming that's a little bit scary.
And I agree. And I know you do like to get political, so we'll try to avoid some of that right now because we're running out of time.
I don't get political. I like fiscal responsibility, conservatives. I like to be able to have an economy that grows, and there's things that have to happen for the economy to grow.
100%. And I think in the midst of all this volatility, what we really need is somebody who's got their finger on the pulse. As we said, with Social Security and all these things, everything's constantly changing. Yeah. And there is no way that we can be the own, CEO of our own finances without having somebody, a president along with us. And that's you guys. So the financial plan is something that they come in, speak with you, and revisit to get them where they need to go.
Right. And what we're doing is we're finding income for you to provide you for your lifestyle.
I love that you continue to talk about lifestyle, because it is so, my needs are going to be different than somebody else's needs who has the same, even given same age, same income, all of that.
Yes.
There's just so many other factors that it's so personal. Health and wealth are the two most personal things.
100%.
Well, I hope you've learned a lot about your financial money matters, as much as I'm always constantly learning from Dean. But if you give that number a call, 520-544-4909, call Greenberg Financial Group, get in and find out whether or not you have a financial advisor you've been working with. If you haven't had these types of conversations that are geared towards specifically your retirement and how to get there, now is the time. You don't want to wait until it's too late to find out that you're not on the right road to retirement. And this is something that they give you complimentary just for hanging out with us and learning a little bit about your money. And if you have questions, please let them know so we can talk about it on the next show, because your money really does matter. Thank you for being with us. We'll see you soon.